Look closely at the screen. What you are seeing right now is one of the most severe fundamental and technical divergences in the entire crypto space. While retail traders are falling asleep at the wheel, complaining about boring price action between $8 and $10, the largest financial institutions on the planet are quietly building the plumbing for a multi-trillion-dollar transition. 7 weeks ago, a highly reliable momentum indicator flashed the most oversold reading in its recorded history. The last times we saw this exact structural bottoming pattern, the subsequent price appreciation was a minimum of 150%. But this time, it's not just a chart setup. We are looking at a permanent shift from speculative crypto utility to foundational, highly regulated global infrastructure. Today, we are going to look at raw, verifiable on-chain data, unprecedented regulatory classifications, and a technical market structure that suggests the accumulation phase is nearing its conclusion. If you care about risk-adjusted returns and capital preservation, you cannot afford to misunderstand what's happening here. Right now, Chainlink is trading in a tight compression zone, hovering right around that $9 to $10 mark. If you look at the broad market sentiment, it's terrible. People are exhausted. The attention span of the average crypto market participant has been completely fractured by meme coins and fleeting narratives. But as smart investors, this is exactly the environment where money is made. You don't buy when the asset is on the front page of every financial news site. You buy when the asset is systematically hated or ignored by the masses, yet heavily accumulated by the people who actually move markets. This is my 11th video covering Chainlink on this channel. I'm not talking about this because of sudden hype or a fleeting trend. I'm covering this because the underlying data is screaming at us. The fundamentals tell us why this level is a generational bedrock, but there is something very specific in the technicals that completely changes this picture. We are going to map out exactly where the institutional liquidation clusters sit and how to position yourself before the rest of the market wakes up. Let's look at the hard data, because narratives are cheap, but capital flows are undeniable. The most monumental de-risking event for this asset just quietly occurred. The United States Securities and Exchange Commission and the Commodity Futures Trading Commission issued a joint interpretation officially classifying the LINK token as a digital commodity. Let that sink in for a second. The regulatory overhang that plagues 99% of digital assets has been cleared. Chainlink is no longer viewed as a speculative security risk. It's a commodity. And immediately following this, the United States Department of Commerce selected Chainlink to bring key macroeconomic data on-chain. We are talking about legacy data monoliths like ICE, S&P Global, and the federal government funneling their data directly through this network. They are setting Chainlink up as the unforkable standard. When you look across the Atlantic, the scale of integration becomes even more staggering. Chainlink and the SIX Group, which is the third largest exchange group in Europe, are actively unlocking the tokenization of over 2 trillion euros in European equities. They are migrating traditional finance onto the blockchain, and every single time those real-world assets require pricing or settlement data, an oracle call is made. That directly translates to protocol revenue. Speaking of traditional finance, SWIFT, UBS, Euroclear, and over 20 major organizations just advanced a solution to the $58 billion annual corporate actions problem. And how are they doing it? By leveraging Chainlink decentralized consensus to reduce AI hallucination risk. They are positioning this network as the ultimate trust layer for enterprise artificial intelligence. And the AI angle goes much deeper than just data validation. Coinbase developer platform engineers recently confirmed that AI agents can now autonomously pay for Chainlink runtime environment workflows. This unlocks a massive, new AI-powered on-chain economy. We are looking at a future where non-human entities are constantly, 24/7, demanding and purchasing Chainlink services. It's a completely new vector of demand that does not rely on human retail trading. If you want proof of product-market fit, look at the revenue. Over a recent 180-day period, Chainlink generated $29 million strictly from cross-chain interoperability protocol transaction fees and payment aggregators. And they are finally sharing that wealth. Through the Smart Validator Recapture program, they recently generated $17 million in revenue, splitting 11 to Aave and keeping $6 million for Chainlink. A transition from a pure operational cost into an active yield generator. Their dominance on-chain is absolute. DeFi Llama data shows Chainlink controls nearly 66% of the total value secured in the Oracle market, effectively securing $44 billion. That's a monopoly, and they are ruthlessly expanding it. On the high-throughput Monad network, Chainlink CCIP is acting as the exclusive bridging infrastructure for Coinbase-wrapped Bitcoin assets, where over $20 million was deployed almost instantly. They are also powering Polymarket, securing their 5- and 15-minute crypto markets. Since that integration, Polymarket saw a 3x volume spike, averaging $153 million in daily volume. Chainlink's low-latency data is directly driving revenue multipliers for the biggest applications in the space. So, who is buying? The smart money. On-chain data from Santiment shows that whales holding at least 1 million tokens have grown by 25% in just 1 year. The high-net-worth entities are aggressively absorbing the supply. We also saw the official Chainlink reserve just accumulate over $1.1 million worth of the token in a single transaction, locking it away and creating deflationary pressure. Retail is slowly catching on too, with token terminals showing a continuous, multi-year upward trajectory to 868,000 unique non-zero wallets. The developer activity remains best in class, with 135 core developers actively shipping code, ensuring the technology never becomes obsolete. And perhaps the biggest gateway for traditional capital has finally opened. The Chainlink Spot ETF data shows total net assets hitting over $100 million. Traditional pension funds and registered investment advisors who cannot self-custody now have a direct, regulated pipeline to park their capital in this network. And for the crypto-native yield farmers, the incentives to hold and provide liquidity are massive. Uniswap liquidity pools for link pairs are currently yielding from 20% to over 100% APY. These yields strongly incentivize large holders to lock their tokens away, thickening market depth and drastically reducing the available market float. Now, let's take all of that fundamental dominance and apply it to the reality of the price action. I have the weekly chart pulled up, and we need to look at the macro market structure. Currently, price is trading below all of our key moving averages. We are below the 21 exponential moving average in red, below the 55 exponential moving average in purple, and below the critical 200 simple moving average in green. By traditional momentum metrics, this is a heavy, suppressed chart. But suppression creates opportunity if you know where the institutional floor is located. Our absolute bedrock support zone is sitting right at $8. Why $8? This is not a random number. This level aligns perfectly with the massive wick liquidation we saw on the historical flush in crypto back in October 2025. Furthermore, if you look to the left of the chart, that $8 level served as the ceiling of resistance during the brutal accumulation phase of 2022 and 2023. In technical analysis, prior macro resistance beautifully flips into macro support. That $8 floor is concrete. On the upside, our closest immediate resistance sits at $10. But the real battleground, the line in the sand, is at $13. If we anchor a macro Fibonacci retracement tool from the local top of $31 back in December 2024, all the way down to our $8 support established in October 2025 and tested again in February 2026, that $13 level perfectly aligns with the 0.236 Fibonacci resistance. But it gets better. If you look at the CoinGlass 3-month liquidation heat map, there's a massive liquidity cluster sitting exactly at that $13 level. That's a liquidation vacuum. Market makers are inherently drawn to liquidity, and that highly leveraged pocket of short sellers represents fuel for a violent short squeeze. We also have a descending trend line, marked by the orange dotted line on the screen, coming down from the August 2025 local top at $26. This trend line will act as dynamic resistance as we push higher. We need to see a confirmed break of the 0.786 fib level, which sits at $26, to officially confirm a macro higher high and structurally reverse the entire multi-year trend. But here's the most important technical signal on this entire chart. Look at the indicator below the price action. This is the Heikin-Ashi RSI. 7 weeks ago, this oscillator reached the most oversold level in its entire history. Since then, it has formed a bullish divergence and is now pointing upwards. This is a textbook bottoming pattern. I have placed white circles on the indicator and matching white circles on the price action above to show you historical context. The last times this specific oscillator setup occurred, they marked absolute generational accumulation zones, followed by price appreciations of at least 150%. We are sitting in that exact same scenario right now. So what's my strategy? How am I managing risk here? I'm slowly and methodically accumulating for the long term. My primary load zone, highlighted by the green box on the chart, is strictly between $7 and $10. I buy on heavily oversold areas, and I scale out in overbought areas. In my honest opinion, looking at the data, now is absolutely not the time to be selling. When it comes to taking profits, my targets are mapped out by the green circles. I'll be scaling out portions of my position at $13 to front-run that liquidation cluster, and then systematically taking profit at 16, 19, 22, 26, and finally holding a core position for the macro target of $45. When you synthesize the fundamental monopoly of the network with the deeply suppressed technical structure, the risk-to-reward ratio here is incredibly favoring the upside. The worst-case scenario involves a macroeconomic shock that flushes the entire crypto market, momentarily breaking our $8 support and forcing a deviation. But given the 25% increase in whale accumulation and the massive APY incentives locking up the circulating supply, the downside velocity is highly buffered. The best-case scenario, and the higher probability outcome over a 12 to 18-month timeline, is that the spot ETF inflows continue to accelerate, the AI agents begin consistently consuming network compute, and the traditional finance integration of real-world assets demands a continuous supply of oracle calls. Once price reclaims the 21 and 55 exponential moving averages, the momentum algorithms will flip from short to long, and that massive token liquidation cluster at $13 will be triggered. We are playing a game of probabilities, and right now, the chart is telling us that the downside is severely limited while the upside potential is uncapped. So to quick recap my thesis, Chainlink has fundamentally matured from a basic crypto utility into a deeply entrenched, highly regulated commodity that powers the plumbing of both traditional finance and decentralized AI. Technically, we are sitting on generational support at $8, backed by a historically accurate bullish divergence on the Heikin-Ashi Relative Strength Index that signals severe underlying accumulation. Let the chart decide, but the data clearly shows that smart money is taking supply off the market while retail remains distracted. The greatest advantage you can have in these markets is patience and a refusal to be shaken out of highly convicted, data-driven setups. If you found this breakdown valuable, please hit the like button and subscribe to the channel so you don't miss the next critical update. Now, if you are a serious investor who values capital preservation and wants to move away from the noise of social media, I want to invite you to join the Pro Capital Vault. This is my private Discord community, accessible directly through the YouTube members of this channel. Inside, you get real-time tracking of my exact portfolio, my precise buy and sell execution zones, weekly live strategy calls, and a comprehensive Sunday prep report to set the tone for the week. You also get direct access to me and exclusive member-only videos. It's a space for disciplined, veteran execution. Click the join button below this video, use the link in the pinned comment, or simply scan the QR code currently on the screen. Once you join, just sync your YouTube account to Discord, and all the private channels will automatically unlock. I highly recommend you go back and watch my last video on Chainlink, where I broke down the specific mechanics of the cross-chain interoperability protocol, as it provides the perfect macro context for everything we discussed today. As always, remember that this analysis is my own perspective and strategy, and does not constitute financial advice. Much love for still being here, manage your risks strictly, protect your capital, and I'll see you soon in the next one.